Welcome to the Transparent FX Academy. I'm Nick and I'm a top author trading with over 190k reputation points. In this video, I will be speaking about USDJPY. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market. Then we will be moving to the order flow by looking at the commitment of traders, so the COT data, so essentially what hedge funds and the big players in the market are doing and how they're shifting their orders. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. If you're new to the channel, make sure to subscribe. This is the place to be for high quality, free trading education. Now, without further ado, let's jump straight onto the charts. Starting here from the monthly time frame, what we can see is that at the moment we have a market which has just created in M pattern from a monthly standpoint. We can see that starting from here, we had this impulse to the upside correction, then the market tried continuing higher. However, it failed and stopped exactly at the previous high before then pushing lower. Now that is the definition of an M pattern, or in other words, simply a double top. Now, after the creation of a double top and the break below the previous low, therefore creating this M pattern, what the market usually follows through with creating is a correction at the neckline of the M pattern, or in other words, at the previous support and resistance to retest this level before then continuing lower. So from a monthly standpoint, given the pattern that the market has just created, usually what we could expect in a situation like this is a push higher before then seeing more bearish continuation. We can also notice that there is a quite important structure level which the market has just broken, which is exactly this one here, which is also the neckline of the M pattern itself. But this is also a previous historical level of structure, which was already acting as resistance here, from which all this previous move to the downside was created. Again, acted as resistance here, from which all this move to the downside was created. Then the market broke it to the upside and that previous resistance was turned support. And now the market has broken back below the level. So this previous support is once again acting as resistance. So as here, when the market broke above the level and retested it as support and then continued higher, also here, since the market has now broken below the level, we could expect a retest of the previous support and resistance and then to see more potential bearish continuation, which in this case would also complete that M pattern that we have previously identified. Dropping down on the weekly time frame, what do we see? Now, from a weekly standpoint, we can see a massive impulse to the downside and no significant retracement. This means that this market has a good probability of being overextended to the downside and in need of a deeper correction. Now, in this case, if the market does follow through with a deeper correction, it would also complete that M pattern on the monthly time frame and go for that monthly retest of structure that we were just speaking about a few moments ago. So monthly and weekly both seem quite aligned for a potential correction to the upside in the short term before, yes, seeing more bearish continuation, but at least in the short term to see a potential move to the upside, testing that level that we have just identified on the monthly time frame. Dropping down on the daily, what do we see? Now, from a daily standpoint, the structure that the market needs to break to the upside in order to continue higher is quite clear. In fact, what we have at this level is a quite significant zone of previous daily support from which this move to the upside was created, which now that the market has broken it to the downside is currently acting as resistance. We can also notice that since we have an impulse and the start of a correction, if we want to measure this correction, we have to take our Fibonacci from the high to the low of the impulse leg, which shows us how we have a 0.32 Fibonacci retracement lining up exactly this area that the market needs to break to the upside if it wants to continue higher, because this is a confluence of resistance zone. So until the market will remain below this level, it can easily continue lower. Now, Before we dig into more detail into what we have here from a technical perspective on the daily time frame, first, let's go and see what we have when it comes to the commitment of traders. So what hedge funds and the big players in the market are doing. Now, if we check the data for the JPY, what we can see is that with the last reports, net positions have been massively increased. We went from having minus 184K net positions all the way up to now having plus 23.1K net positions. Now, this is a clear increase of the net positioning, making the JPY stronger. In fact, we can see 20,000 longs added to the last report and 13,000 shorts getting closed. Now, this is exactly what you expect if USDJPY is trending lower, which at the moment it is. You expect that the shorting of USDJPY is coming from institutions longing the JPY. Because if institutions are longing the JPY, in order to long the JPY, they're simply shorting USDJPY. Why? Because all currencies on the spot are traded against the USD. So if you look at the data for the JPY, you're actually already looking at the JPY USD. So if institutions are increasing their net positioning on the JPY, this means that essentially they are increasing their shorts for the USDJPY by longing the JPY. And in fact, the price action lately has been incredibly bearish, fueled by all this institutional shorting of USDJPY. Now, this means that in the long run, is there the possibility of now seeing a massive push to the upside? That is very unlikely. And in fact, we already spoke about the fact when we were on the monthly time frame that even if from here, there is a possibility of this move to the upside to retest this horizontal structure level. In the long run, everything is supposed to continue to be bearish. If we look at the institutional positioning, this definitely seems like the most probable scenario. However, in the short term, a retest of this level would give the possibility to institutions to short even more. So there is still the possibility of seeing this short-term push to the upside to this resistance level before then continuing lower. However, we have to be extra cautious because, as we said here on the daily, this market is still bearish. And by the way, if you still haven't, make sure that you join my free Telegram channel, which you find both on the screen and also linked in description, so you never miss new updates. Now, back to the analysis. So from a daily perspective, until the market will remain below this area, it can easily continue lower. However, if we get a break above this zone, this is where things get interesting, because if we get a break, this previous resistance would become support. And after the break on the retest of the previous resistance turns support, that is where we have good probability of seeing more institutional longing, which at that point could further increase the probabilities of seeing a potential rejection to the upside away from this level. So if we get this break and retest, what would I expect? Well, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, what I would expect is that if the market breaks above this level and goes for a retest, and the market from an intraday perspective inside of here shifts from an intraday bearish to a bullish market, I wouldn't be surprised to see first a push to the upside, completing that monthly M pattern, and then more potential monthly continuation to the downside. That definitely wouldn't surprise me. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website. Here, you have the possibility to gain access to my entire all-inclusive mentorship program. This is the most complete all-inclusive mentorship program. You will see here a complete presentation of everything included, which is essentially all my courses, including the programming course on automated algorithmic trading. You also have the possibility to gain access to one-on-one private mentoring, all included in the mentorship program, the trading station software with the Telegram signals notification, and also the COT data software, which is essentially the one that we just used in this analysis. So everything all for lifetime access. And if you continue to scroll down, you will see that you will have the possibility after the testimonials to join and gain automatically access with the email and password that you will create during the sign up process. So I really suggest at least to go and check it out at transparentfxtrading.com. You find the link also in the description, and I will see you in it. If you enjoyed the video, make sure to drop a like and also let me know in the comments below any new pairs or topics that you would like me to cover in the next videos. And I will see you in my next breakdown.